Welcome back to The Explainer, everyone. Today, we're putting on our sell-side equity analyst hats to really unpack the staggering valuation and performance metrics behind Jabil. Now, as focused learners, you know that the true story of any business always reveals itself in the fundamentals. So today, we're relying exclusively on raw financial data to build a comprehensive picture of their operational efficiency, their balance sheet leverage, and ultimately whether Wall Street is accurately pricing its future cash flows.
Here is our roadmap for today. First, we'll look at a decade of massive returns. Then we'll dig into their earnings and cash engine, check out their high returns against thin margins, weigh the debt load, and wrap it all up with our valuation verdict. All right, let's jump right into Section 1, a decade of massive returns. 2,132%. Seriously, just let that sink in for a second. That is Jabil's 10-year total return, and it's an absolutely astronomical metric that really sets the stage for our entire analysis today. When you break it down, that translates to a 10-year compound annual growth rate of over 36%. Generating a 36% annualized return for a full decade, that's a feat very few public companies ever achieve. It tells us they haven't just been riding some lucky macro cycle, they've been executing a tight internal strategy that compounds equity value at an incredibly blistering pace. And this momentum isn't just ancient history either. We're tracking a nearly 56% return year to date alone. Zooming out a bit, the 3-year return sits well over 350%, and the 5-year is approaching 581%. The key takeaway here is the absolute consistency of the trend. This growth engine has been revving higher across all recent trailing periods, which shows some serious sustained fundamental strength. Moving right along to Section 2, the earnings and cash engine. Now, this is where the growth profile gets super interesting. The contrast here is actually wild. Their 5-year revenue compound annual growth rate is just a modest 2.91%. So the top line is essentially flat, right? Yet, their 5-year free cash flow growth rate is an explosive 82%. Growing free cash flow by 82% annually on basically flat revenue reveals a story of aggressive operational efficiency and just exceptional cash conversion. They're totally optimizing their model to wring massive liquidity from every single dollar of sales, generating over $1.2 billion in free cash flow over the trailing 12 months.
And you can see how this seamlessly flows right to the bottom line. With a trailing 12-month net income of $809 million, both net income and earnings per share are compounding at extremely healthy mid-teens rates, 17% and 16% respectively over 5 years. Think about it. Even with top-line growth under 3%, their bottom-line profits are compounding at 17%. That is the absolute hallmark of a management team that is laser-focused on margin expansion and profitability, rather than just chasing blind market share. Which brings us to Section 3, high returns, thin margins. To really grasp Jabil's operational profile, we have to talk about return on equity. Basically, this gauges profitability based on how efficiently a company uses the money shareholders have invested. For any equity analyst tracking capital efficiency out there, this is a total cornerstone metric. Get this, they are running on a razor-thin 2.15% net profit margin. In a lot of sectors, a 2% margin leaves literally zero room for execution error. But despite that, they generate a very solid 16.6% return on invested capital and an absolutely monumental 60% return on equity. Keeping just 2 cents of profit for every dollar of sales, but generating a 60% return on book equity, it perfectly illustrates a high-velocity business model. They're moving volume incredibly efficiently and strategically using leverage to multiply those super thin margins into massive shareholder returns. But of course, we have to talk about the risks. Section 4, weighing the debt load.
So the obvious question we have to ask is Jabil carrying way too much debt? I mean, a 60% ROE is an incredible yield, but if it's purely manufactured through dangerous leverage, well, the risk profile changes entirely. Let's look at the balance sheet data.
The crucial focal point here is a debt-to-equity ratio of 2.88. Now, in isolation, that is noticeably high. It indicates they have nearly $3 of debt for every $1 of equity, and this is exactly the mechanism driving that 60% return on equity on a 2% profit margin. They are heavily utilizing debt financing to amplify their operations and boost that shareholder yield.
That current leverage of 2.88 is actually up about 73% from its 3-year average of 1.66. So we are definitely seeing a recent expansion in their debt load. However, we've got to counterbalance this with their liquidity metrics. They maintain a stable current ratio of 1.01, which means their short-term assets adequately cover their 12-month liabilities. The quick ratio, which strips out inventory, sits tighter at 0.68.
So the debt is clearly elevated and definitely requires monitoring, but the current liquidity data shows they're managing that leverage right now without facing an immediate cash crunch.
All right, the moment of truth. Section 5, the valuation verdict. So looking at the multiples, the trailing PE looks pretty steep at 47.5. But when you project forward, the next 12 months PE drops significantly down to about 27. They're currently trading at roughly 30 times free cash flow, but honestly, the true value signal here is that ultra-low PEG ratio of 0.60. By comparing the PE multiple to their earnings growth rate, a sub-1 PEG strongly implies the market is currently underpricing their future growth. It's wild. Despite a historic 2,000% run, the multiples are still flashing a value signal.
When we actually run the numbers through an absolute valuation framework, specifically a discounted cash flow model based on their current filings, we land on a data-driven intrinsic value of $447.03 per share. By forecasting that explosive free cash flow engine we talked about earlier and discounting it back to present value, the model indicates the stock's true underlying worth is pushing right up against the $450 mark. With the stock currently trading around $355, that gives us a very healthy 20.55% margin of safety built into the current valuation. For any equity investor, this margin is your absolutely crucial cushion against forecast error. The fact that an asset can appreciate 2,000% over a decade and still present a 20% discount to its DCF fair value, that's a huge testament to the immense liquidity they are extracting from their operations. So I'll leave you with this final thought. The consensus is often that after a monumental, market-crushing decade, all the upside has just been completely squeezed out. But the raw data tells us a very different story. High capital efficiency, explosive cash conversion, and a discounted valuation all suggest this run might not actually be over. It invites us to ask, can they really sustain a 60% ROE? Will the debt load become a major headwind, or will it be the catalyst for their next leg up? That is the beauty of fundamental financial analysis. It always gives us the next great question to ask. Thank you so much for joining me on this explainer, and keep learning.